Hey, today we're going to talk about the hidden risks of selling put options, especially if you're just starting out. On YouTube, there are too many people who are focused on telling you how much you can make every week or every month by selling put options and how you can make $10,000 a month and retire by selling put options. But investing is risky and selling put options is not without any risks. And they probably tell you that it's impossible to hit the maximum loss, which is when the stock price drops to zero. Yes, maybe it's unlikely the stock price drops to zero, but it's entirely possible the stock could crash by 30% or even 50% below your strike price and might not recover anytime soon. For example, during 2022 stock market crash, Palantir crashed more than 80%. Fortunately, it recovered later on. But there are many other stocks that crashed more than 80% have not recovered yet. For example, PayPal. So when it comes to selling put options, you need to consider all possible scenarios, especially the worst scenario. Let's use Palantir as an example, as this is a very popular stock right now. And the current market price for Palantir is around $35. And this is the option chain for Palantir. If you want to sell put options on Palantir, you're probably thinking that if I sell out of money put options, the probability of a profitable trade is very high. And even if Palantir did fall below my strike price, I still get to buy Palantir at a lower price than the current market price. So on the surface, this makes a lot of sense. But let's look at some real numbers. But let's look at some numbers. Let's say you have a margin account size of $5,000 and you sold three $32 strike 11th October puts for about 65 cents per contract. And let's say Palantir's share price drops to $30 by 11th of October. Now this option contract is worth about $2. So you are looking at a potential loss of about $405. Let's say Palantir's share price drops to $22 instead of $30 by 11th of October. You will be looking at a potential loss of about $2,805. That's more than half of your account size. Let's say instead of selling 3 contracts, you sold 5 contracts, and you will be looking at a potential loss of $4,675. That almost wipe out your entire account. As you can see that if you're selling put options on margin account and if you don't manage your risk well, you could potentially lose your entire account. On the other hand, if by 11th October, Palantir's share price closed above $32, even it closed above $40 or $50 by 11th October, these option trades will only give you a very limited profit of $195. So compared to the potential loss that you could incur, as you can see that the potential loss is much larger than the potential profit. So in this video, I'm going to go through with you what happens if the stock price falls way below your strike price and continues to fall, and what is the potential loss you could face, and what are the possible exit plans in each scenario, and what are the pros and cons of each exit plan, and how you can reduce your risk and prevent yourself from wiping out your entire account. And let's use back the Palantir example. Let's say if you sell 132 strike October 11th Palantir put options for 65 cents and you get paid upfront $65 and your break-even price is $31.35. And what if Palantir's stock price falls to $30 near expiration date? And what happens to your current position? So if Palantir's share price drops to $30 by 11th of October, your 32 strike October 11th Palantir put option would increase in value from 65 cents to $2. So you will be in a loss of $135. Now you can do the following. You can either take loss and buy back your put options to close, or you can choose to roll your put options to a further date. And the third option is you can choose to get assigned and hold Palantir stock. So Let's say if you choose to get assigned and hold Palantir stock at the average price of $31.35. And after getting assigned, you could choose to sell covered call at strike price that is above your break-even price. If Palantir keeps crashing, it will not be feasible to sell covered calls. You will have to wait until the stock price recovers. So let's say you choose to get assigned and hold Palantir stock at the average price of $31.35. After getting assigned, you could choose to sell covered calls at strike price that is above your break-even price. And if Palantir keeps crashing, it will not be feasible to sell covered calls, and you will just have to wait until the stock price recovers. You can also choose to roll your put options. So let's say if you choose to roll your put options, hypothetically, let's say Palantir's share price is about $30 on 10th of October. Let's say you want to roll your put options to a later date, hopefully for a credit. $30 strike November 15th put option is about $2.63. So if you buy back the 32 strike October 11th put options for $2 and sell 131 strike November 15th put, you will get a credit of about 63 cents. Now, you could also choose a lower strike price to increase your chances of closing your position at break-even or even for a profit. Now, the $30 strike November 15th put option is about $2.11. And if you buy back your $32 strike and October 11th put option for $2 and sell one $30 strike November 15th put, you will get a credit of 11 cents. And you could also choose an even lower strike price to increase your chances of closing your position. You could also choose an even lower strike price. Let's say $29 strike November 15th put options is worth about $1.63. If you buy back the $32 strike October 11th put options for $2 and sell one $29 strike November 15th put, you will incur a loss of around 37 cents. So the further you roll out, the higher the premium. So the advantage of doing this is you can roll your option for a credit, but the disadvantage is that you will have less flexibility and takes longer to close out your put options. And the lower the strike price that you choose, the lower the premium. So the advantage is that it's easier to close out the put options, but the disadvantage is you will roll your option for a loss. When it comes to stock market, remember that things could always get worse. So what happens if Palantir keeps falling for the next few months to $20, to $15, or even lower? This actually happened back in 2022 when Palantir's share price actually crashed more than 50% in a matter of months. So let's look at some numbers. Let's use the same example. Hypothetically, let's say Palantir's share price is $30 on 10th of October. Remember that you bought back $32 strike October 11th put option for $2 and sold $30 strike November 15th put for $2.11 on 10th of October, and you got a credit of 11 cents. If you add the 65 cents that you received, you would have a total credit of 76 cents. Let's look at scenario 1, close for a loss. You rolled to $30 strike November 15th for a total credit of $76. But when Palantir falls to $22 on 14th of November, $30 strike November 15th put option is worth about $8 now. And you realize a loss of $724. And if you sold 10 put option contract, that would be a total loss of $7,240. Now, another scenario is you get assigned and continue to hold Palantir stock and wait for it to come back. So you roll to $30 strike November 15th for a total credit of 76 cents. When Palantir falls to $22 on 15th of November, you get assigned and buy 100 shares of Palantir at the price of $29.24. And your unrealized loss, if you sold one put option contract, it would be a $724 unrealized loss when the current market price is $22. And if you sold 10 put option contract, it would be an unrealized loss of $7,240. So the third scenario is you can roll your put option. So let's say hypothetically, Palantir share price is $22 on 14th of November. Remember that you bought back $32 strike October 11th put option for $2 and sold one $30 strike November 15th put for $2.11. You will get a credit of 11 cents. And $30 strike November 15th put option is about $8. So you buy back $30 strike November 15th put at around $8 and sell one $25 strike January 9th and sell one $25 strike January 17th put option for about $3.87. That's for a loss of $4.30. If this new put option expires worthless on 17th of January, then your overall loss is only limited to $4.13. If you sold one put contract, then the loss will be $413. If you sold 10 put contracts, then there will be a loss of $4,130. Let's say this $25 strike January 17th put option is still in the money. You could choose to close it or roll it again. And to reduce your loss, you could also choose to roll to a much further date. For example, instead of January 2025, you can roll it to June 20th, 2025. You'll buy back $30 strike November 15th put at $8 and sell one $25 strike June 20th, 2025 put option for $5.36 for a loss of $2.64. The disadvantage of doing this is it will take much longer to close your losing put option for a profit or even break even. You can also choose to roll to a different strike price. Instead of $25 strike, you can choose to roll to, let's say, $22 strike, which is much closer to the current stock price. If you do that, that would mean that you are willing to take a bigger loss upfront. So you buy back the $30 strike November 15th put for about $8 and sell one $22 strike January 17th put option for about $2.08 for a loss of close to $6. And the advantage of rolling to a lower strike price is that it will be easier for you to close your losing position, but the disadvantage is you will take a bigger loss upfront. So if you sold only one put contract, then your realized loss is $592. If this $22 strike January 17th put expires worthless on 17th of January 2025, then your total loss is only limited to $592. But if your 22 strike January 17th put is still in the money, then you can choose to either close it or roll it again. So should you roll it out far enough to get a credit? So if you choose to roll to a later date, you could reduce your upfront loss by a bit. So you buy back the $30 strike November 15th put for $8 and sell one $25 strike June 20th put for $3.64 for a loss of $4.36. The advantage is you will take a slightly smaller loss upfront, but the disadvantage is you will take much longer to close your position. You also have less flexibility to manage your option position. So to avoid getting stuck in such a situation, this is what I would do. First of all, I can reduce my position size, so that will give me more flexibility to manage my position. And I also will plan my entry price at 2 or 3 different levels. Let's say I would sell put options at $25 strike, $20 strike, or $15 strike at different expiration dates in the event that the price continues to drop so that I can average my price. And I would only do that if I want to hold this stock for the long term. And lastly, I can set my maximum capital allocated to this particular stock. For example, I only allocate a maximum of 5% of my portfolio to this stock alone.